gold could just explode higher, in days. I don't think we're on the verge of hyperinflation like within days, because we still have to have one last major bank bailout or whatever the financial crisis is going to be. We haven't had that yet. So once that happens, I still expect a huge sell-off in everything, including gold and silver, but it would last maybe a few days or maybe in just a few hours. I don't even know. And then the Fed to print like something like $10 trillion overnight, and that should be the end. After that, it should be the end game in, I don't know, a few days to weeks after that.
Gold could move violently higher in a very short window, but the sequence matters. The system has not yet reached its final breaking point, and one more major financial shock still appears necessary before the real endgame begins. Rafi Farber argues that before hyperinflation truly ignites, markets likely face one last large-scale bank bailout or systemic crisis. That event could briefly crush everything at once: stocks, bonds, and even gold and silver, as forced liquidation takes over. However, that sell-off would be short-lived, potentially lasting only hours or days. The response, in his view, is decisive: an emergency liquidity surge, possibly trillions created almost overnight. Once that line is crossed, confidence in the system evaporates rapidly, and hard assets begin to reprice rapidly. At that point, the transition accelerates from crisis to monetary reset in a matter of weeks, not years. Now, we present the clips from Rafi Farber's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I don't think we're on the verge of hyperinflation like within days, because we still have to have one last major bank bailout or whatever the financial crisis is going to be. We haven't had that yet. So once that happens, I still expect a huge sell-off in everything, including gold and silver, but it would last maybe a few days or maybe in just a few hours. I don't even know. And then the Fed to print like something like $10 trillion overnight, and that should be the end. After that, it should be the end game in, I don't know, a few days to weeks after that. So we might have one more shot here, but we're getting to the 2-minute warning now. Silver first broke 50 on October 9th. I said to my subscribers, look, you may, if you have a few extra $100 or something, you may want to get a few SLV call options on, let's say, something way out of the money, like I don't know, whatever the strike was, because once silver breaks 50, it could go much higher very fast, because it's done that before. So we did that, and it made a lot of money. And I already sold out of most of that position. I still have like just a handful left. So I care, but I'm not like stressing over it. I made some nice profit, and that's all. But if you're gonna go all in on derivatives and make a bet on how fast silver's gonna get to some target within a certain short time period, because you have $50,000 of debt to pay off and you're relying on that, it's a bad situation, because that's what the silver short sellers are looking for. If they can get you squeezed out, they'll do it. I don't know if they can, but look, we're in a theoretical. We have to acknowledge, as exciting as this is and all the positive emotions that bring up, we have to acknowledge that we are in very dangerous territory here, because the COMEX could jack up margin rates to 100% if they wanted to, which means that you don't get any leverage exposure. What is it now, like 40%? I don't know. It's I think it's measured in dollar terms, not percentage terms. Last I saw was like $30,000 or something. Could be off on that, but they could jack it up to 100% if they feel really threatened, and then that forces a lot of people out of positions because they suddenly have to fund. Like if you own, let's say you're a hedge fund and you own contracts in long positions in silver, 5,000 ounce silver contracts on, let's say, 30% margin. So that's 70% of the cash you don't have to put into that. And then all of a sudden they're jacked up to 100%. You don't have the cash. You got to sell those. like immediately, or they'll sell it for you by force. This is all technical stuff. I mean, there's nothing to do with the inherent value of silver or anything like that. It's just we're still in a derivative system. They still got a lot of levers to pull here. And you got to be careful. So if you're a stacker, keep stacking. Or if you have enough, stop. But I wouldn't sell here, because anything could happen here. Anything. We could go to 100 tomorrow. We go down to 50 tomorrow. I really have no idea. I don't deny that there's manipulation in silver. I don't think it's a conscious activity mostly. Every now and then you could have like a team of spoofers that get in trouble in JP Morgan. They get fined $100 million or whatever it is. That's nothing. It's just like air. It doesn't really affect much. The real manipulation is the existence of gold and silver futures themselves. That is the manipulation, because that allows people to sell more silver or gold than actually exists. And the exchanges justify that by saying, well, it doesn't matter if they have the silver. If they have the dollar equivalent of the silver contract in their account, then they can settle that in the dollar equivalent of the silver. If they have the silver, great. If they don't, at least we require them to have, if they're shorting a contract, because I had to sell a contract once, right? But to cover my long, I had to go the other side. So they require the full dollar amount of that contract, even if you have the silver in your account, even if you have the warrant, right? You still have to sell a contract short to deliver the warrant to somebody. So technically, I had to short silver once, and I know what's involved to do it. The reason that it looks like manipulation is that any other futures market, let's say oil or wheat or whatever, right? Those are consumed, and higher prices for wheat, they encourage people to consume less because they want to save money, right? There's on one side you have money, which is the dollar isn't really money, but it's more moneyness than the wheat. It's more liquid. In the dollar/wheat equation, you have dollars on one side, you have wheat on the other side. So the higher the price of wheat goes, the less people want to buy it, or any other commodity like oil or lumber or whatever, right? Because these things are actually used. But for a money commodity like silver, when you have dollars on one side and silver on the other side, you have, if you're talking about industrial silver, then yeah, on that equation, the dollar is more liquid than the silver. But if silver keeps going up and up and up and up, the moneyness of silver starts creeping into people's consciousness, and the money in that equation becomes the silver. So that becomes the opposite of a consumable commodity. The higher the price goes, the more people want it instead of the less people want it. And that creates a very dangerous potential for a positive feedback loop, which will spell the end of all futures markets very quickly. And so what happens then is, again, this isn't conscious, but once the silver price keeps going higher and higher and higher and higher, it locks up more and more money there, and more dollars at least, and then all other futures markets get whacked out, like we saw on, what was it, March 7th, 2022, with the whole nickel scenario. There's a short squeeze there. So this could happen, and not by anyone's conscious activity or conscious thought. It could lock up the entire futures market, and that's when the COMEX would have to act, not out of any malice or anything towards silver stackers, but for their own survival, which is exactly what the LME did when nickel exploded. They reversed trades because they had to. So be careful.
Markets are approaching a critical inflection point, but the final phase has not arrived yet. One more major financial shock still appears necessary before the system entirely breaks. Until that happens, volatility will remain extreme and unpredictable across all assets, including gold and silver. The framework described here suggests a familiar sequence: a sharp, sudden liquidation event that briefly drags everything lower, followed by an overwhelming monetary response. Once authorities resort to emergency-scale money creation, confidence shifts rapidly away from paper claims and toward tangible assets. Silver, in particular, behaves differently from traditional commodities at this stage. As price rises, demand does not fall. It intensifies, turning the metal into a monetary feedback loop rather than a consumable good. In a leveraged futures system, that dynamic becomes destabilizing, forcing exchanges to intervene through margin hikes or rule changes to preserve their own survival. Price swings in either direction remain possible in the short term, but the broader trajectory reflects mounting systemic stress rather than normal market behavior. Let's get back to the interview.
A lot of what I say subverts even what stackers like to say, like gold and silver are a store of value. I don't like that language at all. I mean, you could technically say it's a store of value, but that's just a function of the liquidity of these metals. Right? Money is just the most liquid commodity that exists. There's nothing else to it. We're overthinking it by saying that it's anything else than that. It's a thing that changes its price relative to every other thing the least. And that's why people hold, that's why it's a store of value, though value isn't a thing that can be stored. It's not, you can't put it anywhere. It doesn't like live in the atoms of a gold bar. Right? It's a subjective thing, but the material of the gold itself has people subjectively thinking what its value is changing the least relative to everything else because the most people want to buy and the most people want to sell at the same time. Well, what you were touching on was the myth number 10, that you can invest in gold and silver, right? You can't invest in gold and silver. You can only divest your credit, go back into money. Right. The only way to get out of credit is to go into money. There's nothing below the simplest form of credit is the US dollar because all other credit is based on the US dollar. The only way to get out of the US dollar is to go underneath it, and that is gold and silver. So it's a divestment. When you have currency, a currency is just a liability note, a liability that's a ticket for pro rata everything that's on whatever central bank of whatever balance sheet of whatever central bank issues that currency. A dollar, a euro, a Japanese yen, it all goes back to that central bank. So owning that currency, whether in digital or physical form of literally cash on your mattress or a CBDC, if God forbid that should ever come to fruition, that's all just a liability note of the central bank. So owning currency is an investment in those central banks. In order to divest from those central banks, the only way to go is gold and silver, because if you go higher in the pyramid, let's say you own debt, Japanese debt or treasury debt or whatever it is, that just goes higher and higher up the credit derivative, and that's like a leveraged investment in the central bank, right? So, for example, if you're gonna own gold, fine, you own gold. If you're gonna own a gold derivative, maybe you'll own GLD, which is less safe, and it's not gonna do you much good if everything goes down. But even worse, even more leverage than that would be the 2x gold ETF, like what's it called? UGL, I think. So the higher you go in the credit derivative, if you go into debt or you go into stocks or you go into whatever it is else that central banks buy, tech stocks, whatever. I think they even buy options now. So that's all an investment in the central bank. The only way to get out of it is to divest, and the only way to divest from the credit system is gold and silver, because what happens when credit collapses is that credit is only in our minds. That the credit is the invention. Money is not an invention. Money is a natural thing. That's all it is. And the fact that we are exchanging and economic beings, that we trade with each other rather than strictly fight with each other. Of course, we fight with each other. We do that all the time. But we have the ability, unlike any other animal, to trade with each other. And we do that with liquidity. So we discovered what the most liquid commodity is wherever we were. It doesn't have to be gold, but in a global economy, it's gold. And that's what we use. And then credit is an invention. When credit goes away, all the stuff that's here is still here. So that if you can no longer buy anything with credit, you have to be able to buy something with something. And the answer is you buy it with what credit is based on, which is money. I do anticipate it being in 2026, but I caution, I've been wrong about that every time I've said it's going to be this year. I mean, I'm looking at international developments, Venezuela, the Trump administration I'm not for or against it. I'm just saying, like, kidnapping the head of a state that's a very extreme act. And we have hyperinflation in Iran. Suddenly the rial, is that what they call it? The rial collapsed, and now there's revolution in Iran, which I'm happy about, but other people aren't. So I mean, I don't think it's a coincidence that Maduro is kidnapped and Iran is under a hyperinflation revolution at the same time. I mean, these they're part of an axis, and the U.S. is also part of a group, and both are disintegrating at the same time. There's too much happening in the world right now for me to say that this is going to last beyond 2026. I don't see how it could. Someone was passing around an interview of the Nagib Bank Israel, the chair with the equivalent of the Israeli Fed chair, or the Bank of Israel. He was asked about gold, and this is the first time I've ever heard him field this kind of a question. And he said, the question was, does the Bank of Israel have any plans to acquire any gold? Do you regret that you don't have any, that you're one of the very few countries in the world that has no gold, no real assets on your balance sheet at all? And so he gave this kind of waffling answer of, you can always, in hindsight is 2020, if we had known that gold would go up, we would have bought it. It was like treating gold as if it was some kind of like stock pick, right? But I was listening to this interview. I'm like, the shekel is toast. Forget it. It's gonna die, because these guys have no idea what's happening, and they don't know that gold could just explode higher, in days. And all the Bank of Israel has is dollars and a few other collections of foreign currency. That's it. They've got nothing.
Gold and silver are often mislabeled as investments, but that framing misses the core reality. Currency, whether digital or physical, represents a liability of a central bank. Stocks, bonds, and derivatives only move higher up that same credit structure. The only way to exit it is to move beneath it. As global stress accelerates, credit remains a mental construct, while money is not. When confidence fractures, trade does not stop, credit does. What remains is what credit was built on in the first place. With geopolitical shocks, currency instability, and central banks exposed by empty balance sheets, the timeline appears compressed. The transition may be chaotic, but the direction is clear. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.